Good afternoon, and welcome to AIADA's AutoTalk. I'm your host, Rachel Soleimani. Before I introduce today's presenter, a few quick reminders. Everyone that is registered for today's program will receive a copy by the end of this week. And if you have any questions, feel free to enter them into the lower right side of your interface under the Q&A bar. Now join me in welcoming founder and managing director of Kerrigan Advisors, Erin Kerrigan. Erin is a recognized industry expert on dealership buy-sells, valuation, real estate, and private equity, and is often quoted in Automotive News, Wall Street Journal, The Economist, and Bloomberg. I could go on and on about Erin, but instead I'll let her do the talking. So Erin, take it away.
Rachel, thank you so much for having me, and we obviously appreciate our relationship with AIADA and our associate membership. So this is a real honor to conduct a webinar again. In this case, we're talking about expectations for 2020's buy-sell market. I don't know about everybody on the line, but it is hard for me to believe that we are quickly coming to the close of 2019. And I think the question on many dealers' minds is, what will 2020 look like? Not only for car sales, but also for the value of your business. With that in mind, we hope this webinar adds some clarity to that question, knowing, of course, that we do not have a crystal ball. But what we do have is a lot of data to analyze to give us a sense as to what direction we may be headed. Before we get started, I'd like to provide you a quick update on what we've been up to at Kerrigan Advisors and our expanded service offerings. For those on the line who are not familiar with our firm, we are the leading sell-side advisor to auto dealers in the U.S., and we are also, as I said, a proud supporter of AIADA. In the last 5 years alone, we've been honored to represent on the sale of the industry's largest and most valuable transactions throughout the country, including 5 of the top 100 dealership groups, more than any other firm in our industry. We are fully licensed to sell assets, securities, and real estate, and it's important to know that we do not take listings or maintain an inventory of dealerships for sale. We really feel at our heart that the most valuable assets most dealers own, which is their business, should be treated as such when it is sold in the marketplace, sold professionally, confidentially, and with tremendous amount of care and effort. In addition to our sell-side advisory practice, our firm also provides strategic consulting services to dealers as they consider their growth plans and objectives. We also raise capital for dealers who are looking for a financial partner to fund some of their expansion plans, and I'm going to talk about that trend that we expect to continue into 2020. And, of course, our sell-side services. We are focused and grateful that many dealers consider our firm a resource and thought partner through the life cycle of growing, operating, and only when the time is right for them and their family, monetizing their businesses to achieve their personal and financial goals. With that brief commercial, let's jump into the meat of today's webinar. As you will see, I'm employing a Halloween theme to our discussion. It is just around the corner, after all, and as a mother of 3 children, it's a big deal in our household. I see many similarities between this exciting and sometimes scary holiday and today's buy-sell market, which can be full of tricks if you are not careful and treats if you are. I think the trick that everyone is trying to figure out, certainly for next year, is how much longer will our high level of buy-sell activity last? Despite a 9.6% decline in transaction activity in the first half, we are still tracking to over 200 buy-sells this year. That would be the 6th consecutive year of that high level of activity. Our firm estimates that by the end of this year, over 20% of dealers will have sold their businesses since 2013. And based on our firm's pipeline and the analysis we've done of the marketplace, we expect this high level of activity to continue into 2020. In fact, we believe we could see activity increase next year, in large part because of the high volume of sellers coming to market, and also the fact that more buyers, and importantly, more capital, is seeking to invest in auto retail. This is creating a very nice market equilibrium and a lot of buy-sell activity in the marketplace. One very important characteristic of today's market is that more and more multi-dealership transactions are getting done. You can see here that after a 28% increase in last year in multi-dealership transactions. There was another increase in the first half, in that we still have about a quarter of our transactions in our industry are now multi-dealership. That's a huge percentage of the activity. And it's important to remember that large transactions are much more sensitive to the availability and pricing of acquisition financing. The fact that these large deals continue to get done at this elevated pace is the best evidence of all of the health of the buy-sell market, the financial markets, and frankly, the likelihood that it will continue into 2020. Okay, with that backdrop, I thought it'd be helpful to look at the market and our expectations for next year from both a buyer's and a seller's perspective, starting with the buyers. So what are these guys and gals thinking when they want to invest in this industry of ours that continues to have, quite frankly, some negative news headlines? Well, I can tell you they are certainly not looking to lose money on their investment. In fact, buyers today seem to be very excited about the enormous opportunity for a sugar high of future earnings. They view the underlying dynamics of the auto dealership business model as incredibly attractive in the near term, and the potential for industry disruption as a tremendous ROI opportunity in the long term. So while new vehicle sales may decline in 2020, interest in auto retail acquisitions is not expected to follow suit. In fact, Kerrigan Advisors expects the number of buyers, particularly those backed by professionally managed capital, to grow in 2020. This year alone, we are tracking to add 138 new investors to our investor database, a 58% increase over 2018, and that means we'll have over 400 investors in Kerrigan Advisors' investor database looking to invest in our industry. Now, historically, outside capital, such as family offices and high net worth individuals, found investing in our dealership industry very difficult, largely due to the barriers to entry created by the OEMs. For the most part, manufacturers have been highly skeptical of well-funded outsiders trying to become dealers. Seems like everyone wants to be a dealer at some point, but not all the OEMs want them, even if they have a lot of money. However, as transaction sizes rise, these same OEMs are increasingly realizing that their approval requirements may need a paradigm shift. Many of these OEMs are beginning to make quote-unquote exceptions for certain qualified investors, knowing that the most innovative and growing auto retailers do in fact need deep-pocketed capital partners to expand their business and capitalize on the benefits of technology and innovation that will be coming in the future. There are simply limits to what a dealer's personal balance sheet can achieve, and OPM, this is a technical term here, other people's money, can be transformative for expansion. The fact of the matter is it's hard to take the risks that may be required in the future to innovate in this business model when you are just relying on your family's balance sheet. And we do think that you're going to see more and more dealers turn to outside capital to plan their future in this business. One of the investor groups that we are seeing continue to show interest in our business is international investors. And our most recent transaction activity certainly supports this trend. 4 of the last 7 dealership groups that we have represented have been acquired by dealers either backed by international capital or, in fact, that are international auto retailers. And a real testament to the interest in our industry in the U.S. is the breadth of the distribution of the Blue Sky Report. Many of you on the line may receive that report. If you don't, we're happy to add you to our distribution list. But that list, interestingly enough, purely from people requesting our report, has expanded to over 9,000 contacts in 35 countries. As far afield as Pakistan, folks are looking at the U.S. as an incredibly interesting market to invest in large part due to our very attractive franchise laws and the support of associations like NADA and AIADA and your state associations that ensure that your franchise value remains very strong and frankly ensures that you can't just have your franchise taken away. And therefore, that's highly attractive and not something that many of the dealers in other countries have those kind of protections against the risk to the franchise value that we do in the U.S. Now, why is there an increase nonetheless in all this investor interest? Why do we continue to get contacted, it appears weekly or more than twice a week at our firm by even a new investor saying, we want to invest in auto retail? The answer is actually pretty simple, and it is the fact that investors love the resilience of our diversified business model, and that's not going to change in 2020. You can see here that what's incredible about our model is even though new vehicle sales, the unit sales have been declining, revenue hasn't been as much because, of course, cost of new vehicles is going up. But with unit sales declining, our industry is still seeing an increase and a stabilization, really, in earnings. And that is highly attractive to investors. They love businesses that have countercyclical dynamics, and that's exactly what we have here. You can see that in the first half of 2019, much to many people's surprise, earnings actually ticked up for the average dealer according to NADA, and the publics also reported as a group record earnings. Many dealers with whom we speak say that 2019 and they expect 2020 to be very strong years, despite the fact that new vehicle sales are on the decline. The other thing investors really like is that our average return on equity is over 20%. There are very few industries in the world that can show that kind of high average consistently. And as I already mentioned, we have these very strong franchise laws. On top of all that, there is so much opportunity for acquisition. We are in a fragmented industry, and consolidation can drive growth in sales and certainly growth in earnings, especially when the benefits of these sales go through fewer dealerships as we continue to see the consolidation of the industry. And with fewer dealerships, you also see higher gross profit per dealership. You see here, this is rarely reported. On this slide, we see that gross profit per dealership has actually been rising quite considerably, according to NADA, driven, of course, by the higher margin parts of our business model, namely used vehicles, sales, and service and parts. This is really quite remarkable to many when I show them this slide, because they say, well, gosh, all we hear about is how new vehicle margins are shrinking. Well, that might be the case, but the highest margin parts of our business are growing and growing nicely. When you think about the service and parts department in particular, the investors just adore this part of your business model. It is a recurring revenue business. It is 50% gross margin on average and represents one of the fastest growing parts of the entire industry, with growth expected to continue as more vehicles enter that sweet spot of customer pay coming off warranty after all these high sales. Since 2014, for instance, the used vehicle sales, which is used vehicle margins are about double that of new, have increased 10%. Fixed operations has increased an incredible 27%. By contrast, new vehicles, which we tend to spend so much time discussing, but in fact is not the driver of our profits, or in some cases the growth in our business model, have actually been on the decline. Today, fixed operations and used vehicles represent 76% of the average dealer's gross profit, while new vehicles represent just 24% of gross profit. And investors also like another aspect of this industry, and that is it's so nimble. Look at how fast our dealers were able to shift into the used vehicle side of the business equation as new vehicle sales slowed and as margins declined. Today, our industry is approaching a 1-to-1 used to new ratio, back to where we were basically right after the recession. That is an incredible shift from just even the end of last year. And it just shows our ability as an industry to really identify the profit centers and move quickly into them to retain and sustain profitability even when new vehicle sales decline. Dealers have also shown their ability to capture loss margin by improving F&I sales. You can see here that F&I per new vehicle sold has increased 60% since 2010. And this is another example of the innovation and opportunities to really capture new profit centers within the auto retail business model, and again, to either grow or at least sustain profitability. Another really interesting aspect of our business model is the fact that we are actually a pretty high variable cost structure industry, meaning we don't have a lot of fixed expenses. 70% of SG&A is variable in a dealership. what this really results in is that we can cut costs quickly in the event that sales decline. Even in the face of one of the worst economic times we can all remember in recent history, the Great Recession, dealers were able to cut expenses and actually more than double net to sales in just a year as a result of what they saw in the marketplace. Very few industries, again, have this nimbleness and this ability to adjust and restructure so quickly. In fact, in 2009, the average dealer had a 10% return on equity. I mean, that is an aberration from most retail industries, and it is this consistent profitability that has really caught the eye of, again, a lot of smart money. Now, all this being said, some industry observers are still quite surprised that we continue at Kerrigan Advisors to have this growing pool of buyers, and these buyers that are excited about the industry, especially given all the noise about industry disruption. Interestingly, we have found buyers are not that fazed by the headlines. Many are studying the disruption risk and see that the data is pointing to it being decades away. Certainly not in 2020 are we going to see a result, a significant change of all this discussion of electrification, for instance, in our industry. You can see that not until 2030 does the Edison Electric Institute, which is focused on getting more electric cars on the road, do they think it will even see a blip in the number of units in operation that are electric? In fact, it'll just be 7%. So 92% of vehicles in over 10 years will still be combustion engine vehicles. And what they're finding is that these owners of electric vehicles tend to be more committed to coming back to the dealership. So as David Holt, the CEO of Asbury, said, for those that are worried about electric vehicles and what's going to happen to parts and service, I would respectfully say it's going to be a long time before there is an impact on our business model. And for those who are worried about the millennials not buying cars and the cool city kids, you can see that they are not actually choosing ride sharing at the level people thought. In fact, we have some good news. Their car purchases far outweigh their growth in population in the major urban centers. Even New York City, the most urban of all, saw more than double increase in household vehicles relative to population growth. So we are not seeing people forgo the car for ride sharing. In fact, ride sharing has increased the number of vehicles being purchased on the fleet side. And finally, there has been a dramatic walk back on the expectations of autonomous vehicles. I think a few years ago, people predicted they'd be all over the place next year. That is now definitely not a reality. In fact, the fact of the matter is they are in their infancy, highlighted by this report coming out of CES last year. I think the headline of this Wall Street Journal article says it best: driverless cars tap the brakes after years of hype. So in terms of the effect of all of this change in 2020, I don't think you will actually see any of it. We certainly haven't seen anything priced into the buy-sell market. Now, all of this being said, that's not to say that technology improvement in retail efficiency will not be important to the future of auto retail. In fact, we are finding that buyers and investors are very focused on ways to increase industry profitability to make consolidation an even more lucrative endeavor. An example of this is our recent clients who successfully employed one-person, one-price sales processes. These clients dramatically reduced their cost of sale and increased their store profits to levels 3 to 4 times industry averages. I'm talking about 40 to 50% net to gross, 6 to 8% net to sales. Their profits were generated not from the one price. Everyone in our industry seems to be fixated on this one price, even though the fact of the matter is our industry is very transparent and everyone's pretty much at a very low margin price today. What really was the dynamic that drove profitability in these stores was the fact that they reduced the cost of delivering the sale, and thus became highly efficient with their average revenue per employee over $1 million, significantly higher than NADA and approaching the Amazon average. This is going to be the key in many cases, we believe, to the future of our industry. Right now, so much of our front end is still structured with layers of staff and layers of management to achieve a margin that is really disappeared. So the key is to cut the cost structure of delivering the sale. In this case, these dealerships had sales managers and sales staff who sold an average of 20 cars, and there was no F&I department. Now that really creates a lot of profits when you can get that model working. And these investors that I was talking about are also well aware that Wall Street is enamored by these kind of alternative methods of retailing, believing there is an Amazon model to be had in our trillion-dollar retail market. Whether that is Carvana or some other startup, this valuation opportunity is also a driver for some of the outside investors who want to get in so they can see how they can innovate in this huge industry and see if they can also get some of these high levels of valuation multiples that folks like Carvana are achieving, because obviously Wall Street is enamored. It's pretty incredible to think that Carvana is valued at 2 times Penske's market cap and 2 times AutoNation's market cap, despite the fact that they are not making money. Before I switch gears to the sellers in the marketplace and what we're expecting for 2020, I would be remiss if I did not also speak about the largest companies in our industry, and of course that is the public companies. Now, we look to the publics not because they are the most acquisitive, as you can see here. In fact, they are not very active right now, but because they are some of the largest companies in our industry, and their valuations are marked to market every business day. So we know exactly what AutoNation is worth right now, and we like to analyze their spending levels and their valuations as really an indicator of which direction the industry could be going. So with that in mind, some were quite surprised to see how much they slowed their acquisition spending in 2019, worried that their 60% decline could be a precursor to a slowdown in the buy-sell market. I'm here to share with you that we do not think that is the case, and here is why. These companies' decline in spending was largely driven by the 30% decline in their stock price in the second half of 2018. As tariff threats and economic fears really spooked the market. Maybe you all remember the market really took a nosedive in the second half of last year. With their valuations plummeting, many of the publics found acquisitions undoable because they would be dilutive to their earnings. In fact, some of them were even trading below the average private dealer's multiple. Interestingly, coming into 2019, these companies have seen an incredible rebound in their valuations, increasing 37% according to the Kerrigan Index. This is our proprietary index of the 7 publicly traded auto retail stocks. Wall Street has clearly taken note of the stability and growth prospects of these companies' earnings and our overall model, particularly, of course, for the largest companies in our industry. They're saying, gosh, these guys, even with the news about slowing new vehicle sales and disruption, the numbers speak for themselves. These companies are making a tremendous amount of money. So with this higher valuation, these higher market caps, we expect the publics to be more acquisitive in 2020, armed with higher multiples. Public blue sky multiples are now trading above where they were, of course, last year, and far above the industry private average. Before, they were not doing that, and therefore, of course, they didn't do as many acquisitions. But now they're actually today even higher than 5.9 times, closer to 6 times. So we expect them to be more acquisitive because more deals in the marketplace are accretive to their earnings. And again, these companies have a fiduciary responsibility to complete acquisitions that provide a high return on investment to their shareholders. One more thing to keep in mind as it relates to the transaction activity of these public companies is the fact that, right or wrong, our industry takes a while to get deals completed, in large part because the OEM approval process adds at least 2 months in our experience to the process. So when you take into account the marketing, the negotiating, which of course car dealers like to do, and the due diligence period and approval and closing, the average deal is about 6 months. So what does this mean? When the public stock prices were on the decline in the second half of 2018, the effect of that decline was felt in the first half of 2019, as we saw in the numbers. Now that the stocks have rebounded so nicely in the second half of 2019, if these companies enter into transactions in the third and fourth quarter, those transactions will likely be announced in the first and second quarter of next year. So effectively, there is a lag when their valuations move up and down to their acquisition activity. Their current rise could portend an increase in acquisitions in 2020, especially given, again, their higher multiple and the fact that more transactions are accretive to earnings. We also believe that the pace of their divestitures will slow in 2020. After 18 months of shedding 70 franchises relative to just 31 acquisitions, so they have been on the decline as a group in terms of the number of franchises they own, we think you may begin to see the total franchise count of the publics start to rebound like their stock price. And Cheryl Miller, the new CEO of AutoNation, basically said as much. She thought the pace of divestitures would slow and indicated that they would be looking at acquisitions. To close out our view on the buyers and expectations for 2020, as much as we love to analyze all this public data, I'd like to remind everyone on the phone that 94% of our industry really is a private industry. The publics are a very small sliver of our industry. And in terms of the acquisition market, similarly, about 90% of acquisitions are done by private dealers. Most dealerships are owned, of course, by families and successful entrepreneurs, and we don't see that changing anytime soon. We do see them partnering with deep-pocketed investors more and more to grow their groups, but again, there is so much opportunity in this private sector of the industry, which again is one of the reasons we see so much capital looking to get in, because they see so much consolidation that they expect in this industry in the next decade or so. That's actually a great entree into our next section, which is, now that we've talked about what the buyers are looking like in 2020, let's talk about the sellers. Perhaps not surprising, we are seeing more sellers coming to market a bit fearful that if they don't sell now, they may have to sell under duress to a large group gobbling up smaller dealers. This is the nightmare that sellers want to avoid. And if you look at the contraction in the dealer body, you can see what is driving this concern. Certainly, our industry has been contracting for some time. It's not a recent phenomenon, with the numbers of dealers reducing in our analysis by about half every 40 years. I think the big question is what will happen in the next 40 years? Will we have 4,000 dealers, 3,000, or as a JP Morgan analyst said, 10? I don't think it'll be 10. I don't know how many it'll be, but nonetheless, it'll be fewer. This is particularly concerning for many dealership families who are now at that critical juncture of deciding whether the second generation or the third generation or the fourth generation is up to the task of leading their family retail enterprise through what will eventually be significant change. These dealers are also keenly aware that few family enterprises make it through these generational transitions. In fact, just 30% make it to the second generation, according to a Harvard Business Review study, 12% to the third, and a measly 3% to the fourth. Now, our industry has certainly bucked this trend, but still, with these odds stacked against them and with the drumbeat of change sounding ever louder, more and more multi-dealership dealers are choosing to sell their business rather than attempt to defy these statistics. And I like to always say that, in my experience, dealers think in generations, not decades. So while the changes coming to auto retail are probably not going to be that significant in the next decade, and we don't see it priced into the value of dealerships today, if you're looking at the next generation is going to see these changes and have to manage through these changes and this risk. And some of the next generation actually doesn't want to do that. They're worried about the risk. And some of the dealers don't want to pass on that burden to the next generation, knowing that it's not going to be the same as what they were able to do in their industry, where it wasn't changing maybe quite as much as it will in the next 30 years. This is particularly true as dealers increasingly realize that scale matters in today's industry. Our industry is definitely shifting from the average dealer owning 1 to 2 dealerships to 9 plus. And in this environment, it's not surprising to see dealers decide that maybe it is finally time for us to consider a sale. The fact of the matter is that the skill set required to run a large multi-dealership operation is quite different than that of one store. Few families are set up to manage this kind of operational complexity. I don't know about everybody on the line, but it's hard enough for our family to figure out who is going to host Thanksgiving. I cannot even imagine owning 9 dealerships with them. In addition to the industry changes and succession challenges, some dealers are also focused on the current economic cycle. After all, we are entering the longest economic growth period in our country's history, with signs that it may be coming to an end in the next few years. For those that listened to the Cox webinar that I think was a few weeks ago through AIADA, their economist expects that in 1 to 2 years we will be in recession. These dealers are particularly sensitive to the rising debt levels that we are seeing in the industry on many dealers' balance sheets, which could cause some distress and certainly would prohibit dealers from making acquisitions. They are also aware that while most dealers are doing very well today, there has been a rise in dealers having financial troubles, which often is a precursor to a recession. In addition, many are aware that valuations are strong today, particularly when including real estate in the equation. While the average blue sky value has declined about 10% from its high in 2015, but is still quite high, largely, of course, due to the decline in dealership earnings, average real estate has risen 18%, resulting in a net increase of over $1 million for the average dealership enterprise when including real estate. So sellers who own their real estate and sell it as part of a transaction are still achieving peak transaction values, even though blue sky is down. Interestingly, with interest rates now on the decline and earnings improving, we expect blue sky values will stabilize in 2020, bringing more sellers to market next year, eager to ensure that they will not miss their exit window. And many are aware that what goes up does often come down. As you can see here, we estimate that while dealership real estate prices have risen incredibly over the last 4 years, we could begin to see them come down slightly as dealers find it more difficult to support the rising rents, and frankly, as more big boxes go out of business, as consumers turn to the digital world for retailing and are using less and less bricks and mortar retailing. Okay, now that we looked at our expectations for 2020 from both a buyer's and a seller's perspective, and we've talked about why we believe there'll be an increase in both parties coming to market next year, let's talk about franchise values. Much like the candy trading that will undoubtedly go on for days after Halloween, until, of course, moms like me throw away all the candy, there is more art than science in many cases to valuing a franchise. I'm always reminded that a dealership is only worth what a buyer is willing to pay and what a seller is willing to accept. And that can very much be in the eye of the beholder. Just like candy, I mean, who knew that a M&M's and a Kit Kat could be worth 3 Starbursts? I can tell you I wouldn't take that trade. I'm a chocolate lover. That's a terrible trade. Similarly, we find that some dealers love certain franchises and some buyers won't go near certain franchises. So it very much depends on the buyer and the market and the transaction. We are often asked why some deals trade far above the multiples that we publish in the Blue Sky Report every quarter and some trade below. In our experience, there are really 6 key factors that drive multiples up and down from what we publish. And I want to point out that these multiples that we publish should be applied to the most recent trailing 12-month adjusted earnings, reflecting earnings that a buyer would expect on day 1 of acquiring your dealership. So the buyer is not going to be paying for personal expenses of the seller. The buyer is going to be getting the hard pack on service contracts that might not be going into the financial statements. So they definitely adjusted earnings, and it's EBIT, not EBITDA, which often is something that a lot of sellers think that it's EBITDA that buyers are looking at. They're typically looking at earnings before interest and taxes. So with that being said, here are the factors that we see driving up multiples. The first one being earnings growth expectations. And in this case, what we see is that if a dealership is underperforming, oftentimes you'll see a much higher multiple. Now, this is more the case with the top franchises. We see buyers willing, for instance, on a Lexus franchise to pay a multiple far above what we publish if the dealership is underperforming and the buyer knows they can get the earnings up quickly. So effectively, that buyer is pricing the deal on a pro forma basis, looking at their return on investment and what they can expect and what they're willing to pay on that deal based on their earnings growth expectations. We find that on the riskier franchises and the lower multiple franchises, buyers are less willing to do this. So you're not going to see underperforming weak franchises have as high a multiple boost as you would see top franchises. Think the Toyotas, the Mercedes, the Hondas. Those kind of franchises also often will have a real boost if they're underperforming in their multiple. Now, the same can be true for an overperformer. If you're overperforming tremendously, especially with the weaker franchises, if you have a Kia franchise or a Nissan franchise or a Hyundai franchise that is just killing it, doing 8% net to sales, usually I share with those individuals, you are doing an amazing job. You should keep your franchise and keep making a ton of money, because the buyer's not going to give you full credit for that incredible performance, often because the performance is driven by you, the operator, and not necessarily the franchise. And so unless that operator is going with the deal, then the buyer is less inclined to necessarily pay a full multiple on overperformance. The next is buyer demand, and this is certainly a really big one today. This is really where markets come into play. So certain regions, certain states are in high demand, and the multiples are higher in those markets. Florida, Texas, Arizona. These are also markets that are easier to do business in and have really great franchise laws. So these franchises tend to make a lot more money in those markets. There's a huge amount of buyers looking in those markets, and therefore the multiples are higher. Our firm is very active in Florida right now, and we're definitely seeing this to be the case. Now, the opposite is true. If you're in a market that doesn't have a lot of buyer demand, it's just economics 101. You're not going to have as high a multiple because there's just not as many folks looking in those markets. The next is real estate. If you have a real estate project, you're going to have a discount on your blue sky multiple. And that is just, unless, of course, you're in one of these top markets, sometimes there's no discount. But generally speaking, real estate projects are perceived as a negative, especially as we think about potentially being in a recession in 2 years. Buyers don't want to buy a dealership, build a new beautiful facility, and then be burdened by a high rent factor, which puts risk on their business. So that is a challenge in today's market. If a dealership is perfectly image compliant and the rent factor is in a good position, that can actually improve evaluation. Market vehicle preference. This is simply to say that dealerships and truck markets tend to have higher multiples. We just sold a high volume Ford dealership in Denver. That is certainly a truck market, and Mike Maroney, the former president of AutoNation, was the buyer. Was very pleased with that acquisition because he knew that was going to be a great deal in that market. Now, truck dealerships in places like Los Angeles, not as much demand for those kind of franchises in a place that you don't have as many truck buyers. Next is market representation. Now, this is to say that single-point markets tend to be valued at a higher level. We recently represented the Lexus dealer in Minneapolis. There was only one Lexus dealer in a huge city like Minneapolis, actually the whole state. As you can imagine, that's a really attractive business model. You don't have any franchise competition. Your margins tend to be higher, and those are very consistently strong, profitable dealerships, and therefore tend to have higher multiples. And customer relations. Now, this is something that we were rarely asked about in the past, surprisingly. No one would even ask us what the CSI or SSI was for our client, and we thought that was kind of interesting. Now, what we're finding is buyers may not be as focused on that as they are on what is the social media reputation of your dealership, because that's not something you can change on a dime. And so I do think that making sure your customer relations, your social media reputation is strong does have an effect on the overall value of your business. More and more buyers are researching that, and that's coming into play as it relates to valuation. Taking all these 6 factors into play, again, you can see valuations above or below what we represent in our blue sky multiples. They really should be considered guideposts to your own analysis, but a lot more analysis needs to be done before you just pick a multiple and throw it on the most recent earnings. One thing that we thought you all would find interesting is the tremendous increase in the domestics buy-sell market share. You can see that it's more than doubled since 2015, mostly at the expense of import luxury and import non-luxury franchises. In the case of luxury, as interest rates have risen, the return on investment requirements have risen, and therefore we've seen the pricing more difficult to achieve for these very expensive deals for some that are, if you have $100 million, you probably want a pretty nice return on that $100 million, and you have alternative investment opportunities. So maybe you won't buy that top luxury franchise. Although we do still see them trade, and they do trade still at very high numbers. Also, import franchises likewise tend to have higher valuations, and it appears that their market share in the buy-sell market has declined. This slide just simply points out the obvious, which is the lower the multiple, the higher the expected return. Now, the higher the risk of that return also, so it's a risk-reward scenario. And the higher the multiple, the lower the expected return. But again, those franchises like a Porsche that have very high multiples, the risk factors associated with their earnings are expected to be lower. So maybe you take a lower return because you know the value of that Porsche franchise isn't going anywhere. It's a great and long-term investment. Interestingly, as it relates to the domestics, one of the reasons we might continue to see domestics take share is that their rent factor as it relates to gross is the lowest of the four categories tracked by NADA. In contrast, luxury and import have pretty high rent factors, and as we know, this can add risk to a business model, especially if economic times become more challenging. And so this may be one of the reasons that buyers are more interested in domestics today than they had been in the past. Another thing to think about is just the overall sales per franchise, which we do find sales per franchise combined with the profitability of a franchise as it relates to the franchise versus who's running the franchise. What we see is that those franchises that are very much reliant on the operator of the franchise, again, dealers can make tremendous amount of money, and Mazda and VW and Buick GMC and all those franchises in the bottom left quadrant, but usually it's because they have a phenomenal operator who is doing tremendous in used cars and other parts of the business model. By contrast, we see the consistency of the earnings in franchises like Subaru, Honda, and Toyota in the upper right quadrant is really what drives buyer demand for those franchises. We also, though, do see more, as we mentioned, interest in the Fords and CJDRs and Chevrolets in certain markets, although we do actually have a negative outlook on Chevrolet's multiple, in part because some of the challenges they're currently dealing with the union talks. Okay, I'm going to wrap it up here as we're quickly coming on 45 minutes here of this webinar. Here are our multiples that we published in our most recent report, and we go into great detail on what drives the changes in those multiples. You can see the analysis that we do for each of these franchises, and we really look at buyer demand. If any of you on the line are looking to acquire dealerships, while we only represent on the sell side in the buy-sell market, we do spend a lot of time with buyers understanding what they're looking for to make sure we're only approaching buyers with opportunities that make sense to their criteria. So we do have on our website a place where you can enter in all of your criteria, and we track it, and we analyze and keep track of all of that data for every transaction that we represent on. So buyer demand, of course, is very high, and it's highly correlated with higher multiples in the case of Toyota, Honda, and Subaru. Change in sales, we obviously track sales per dealership, probably one of the best indicators of consistently high profitability and consistently high buyer demand and just higher multiples. We also track buy-sell market share. This can be a little bit deceiving in that sometimes the market share in the buy-sell market can be higher in part because I should point out that there are more domestic franchises, so clearly there's always going to be more buy-sell market share there. Also, you can see that Nissan has a high buy-sell market share, although we have a negative outlook on that franchise because of all the challenges. It might be the case that more Nissan dealers are deciding to sell, or more dealers that have groups are deciding to sell off their Nissan franchises. But we do see certainly some buyers are buying the dealership, so it is a good indicator to track. We also look at the credit ratings of the manufacturer. This is an indicator of their ability, these OEMs, to invest not only in product and their network, but also to have a strong captive finance company that can help to support dealers and their consumers. In this case, TFS is probably one of the most valuable parts of the Toyota franchise. Not only do they finance the acquisitions of cars for consumers, but also acquisitions by dealers of other dealerships, and that can help to improve the blue sky values. Here are the multiples for our luxury franchises that reported in our most recent report. You can see that Infiniti also did see a decline. Again, not probably surprising. They're now in line with Acura and Cadillac in terms of their top multiple. And here's analysis that we conducted for these franchises. You can see that there's really a have and have not scenario with there's top franchises that are in demand, although I will note that demand has been on the decline, with the decline in their sales and some variability in their dealer profitability recently. And we actually have noted that there has been, to our records, 0 BuySells in the first half of the year of Audi franchises. So that is also probably an indicator there. We also note that Volvo is improving. You see an increase in buyer demand. We see an increase in sales, and so we could see more Volvo transactions in the coming year. In closing, while there is a tremendous amount of change that we've discussed in our industry seemingly on a daily basis, I am here to reiterate what AIADA has been saying, which is that the auto dealer is not a dying breed. The fact of the matter is that change does not have to be scary. It can be the opposite. Like Halloween, it can be fun, exciting, and even exhilarating because it can create tremendous opportunity. There is no question in my mind that fortunes will be made in 2020 and beyond with innovations in retailing and opportunities for consolidation. The decision for everyone on this line is, which way are you going to go? There's really not a bad way to go. Capitalize on today's strong values or invest in our incredibly attractive industry. In 2020, you have great choices because both options will have great outcomes in our estimation. With that, I want to thank AIADA for the opportunity to present this webinar today. And if anyone has any questions, you certainly please reach out to me. My contact information is on our website, kerriganadvisors.com, and I'm happy to have a confidential conversation with you or answer any questions about today's presentation or the Blue Sky reports.
Erin, thank you so much for taking time out of your busy schedule to speak with us. We really appreciate it. And I extra appreciate the Halloween touch you added to the presentation. Like Erin said, if you have any questions, you can contact her through kerriganadvisors.com. If you joined us a little bit later, you will be receiving a copy of this presentation by the end of this week. To keep our Auto Talk series going, join us back here on November 19th as our used car guys return, Bob Grill and Mike Rossman, to discuss how to protect your used car margins. Be on the lookout for promotions on how to register. For more information about AIADA, visit aiada.org or call 1-800-GO-AIADA. Thanks, everyone, and have a great day.